Well, good afternoon and welcome to our next instalment of Nucleus Insights, the boom and bust of China. My name's Tim Fuller and I'll be comparing today's presentation. So we've got over the next 40 or so minutes, we're going to be running through some commentary and thoughts on the boom and bust of China, along with obviously some graphs and data to complement this. I have sitting with me here, of course, David Llewellyn-Smith, who I'll introduce in a moment, and also Damien Klassen. And so what we'll do is we'll fire through it. Now, just a note to anyone who's attending live, we've got our live chat box available at nucleuswealth.com/webinar. If you'd like to, if you're not watching there, please head over that way. And we've got Maddie, our communication expert, monitoring the live chat box for any questions along the way. There'll also be time for live Q&A at the end as well, if you want to hang on until then. So there we go. Just before we do fire into it, of course, we've just got to run through a quick disclaimer. Of course, as always with presentations like this, we do aim at Nucleus Wealth to present informing and sometimes entertaining content. But of course, please consult your professional investment advisor or financial advisor before making any decisions discussed today. Or of course, come and talk to us. So my name's Tim Fuller. I'm a certified financial planner. I've been working for a number of years across in the personal advice space for both large companies and also small companies, and finishing before starting here with purely in the SMSF space. I'll of course now introduce David Llewellyn-Smith, outside of co-authoring The Great Crash of 2008 with Ross Garnaut. He's a chief economics editor and founder of the Diplomat magazine, and now is the chief editor of the highly read Macro Business blog. Welcome to you, David. Got a nod of the head. And also, of course, Damien Klassen, who's our head of investments for Nucleus Wealth and the MB Fund. A very broad and quite involved history there. As you can see, a number of years at Schroders, managing some pretty serious money. Spent some time at Wilson HTM as a head of quantitative strategy, and prior to that was, of course, the founding partner and head of research for Aegis Equities, a company that was putting together stock reports for it seems like many people. There's not too many people I've spoken to who haven't heard of Aegis. So welcome to you, Damien.
Thanks, Jim.
We'll jump right into it. So the agenda today, we're going to, Damien's going to run us through some of the structural issues, of course, in China, and then David's going to follow up with some of the cyclical issues from an economic standpoint in China as well. And then we're going to bring it all together towards the end in regards to investments. So what we're looking at or what you can do in terms of looking at your investments and what we're doing as well. So let's jump into it, Damien. The structural there. So it's the start of our structural, of course, the Chinese GDP. It's an interesting beast, I'm sure. Could you want to just cracking off and letting us know your thoughts?
Yeah, sure. Thanks, Jim. Look, I probably should just for the more novice listeners, I should just explain what we mean by structural and cyclical. So structural are sort of big picture, long-term problems within the Chinese economy. And so we sort of see that trend line certainly headed down, and we'll run through a few charts on that. But around that, you're going to get some cyclical swings. So you sort of you will get cycles up where you'll get some more debt thrown at growth, and Chinese growth will come along, and then you'll get it fading off again. And so and David's going to talk about those types of issues, so the more short-term issues. And what I wanted to do is talk more about the long-term issues. Just on this one, I'm just noting that Chinese GDP is not the same as GDP elsewhere, in that they generally don't tend to recognise write-downs within their numbers. And so what that means is that if you go and build a bridge in Australia and nobody uses that bridge and you don't make the money you expect from it, is that then gets written down and taken off GDP. Whereas in China that doesn't happen. So you do find that Chinese GDP it's not comparable, and you will find that it's higher than other numbers, higher than in other countries, and for that reason, you'll get for that reason, some of these statistics which we're going to show are distorted by the fact that the GDP is overstated.
Okay, yeah, fantastic. And obviously, the Chinese GDP has sort of been staggeringly high, I guess, in comparison to a lot of the other parts of the world. So I'll be very interested to see what we've got here.
Yeah, so the first chart I wanted to run through was the thoughts on Chinese capex. So this is the key one, the key long-term issue we have with China. So there's this path developing countries can try and follow to riches, and we saw Japan sort of pave the way with this. You've seen a few other people try. Korea had a go at it, and they succeeded, to a relative sense. Thailand sort of tried the same thing, a little bit more mixed, and Russia is probably an example people don't mention much, where they sort of tried this and failed. So the idea is that what you do is you try and get your you rebalance your economy away from consumption, and you put it into capex and capital expenditure and building roads, bridges, infrastructure, all these things that then help your economy. So you get your people employed, and then from there you can then start manufacturing and you grow your economy, and you go from being a developed economy from a developing economy to a developed economy. Now, the problem with this is what tends to happen is countries that start down this path get addicted to the capital spending, and the people who make lots of money from it, they love it, and they want it to keep on going far beyond where it actually becomes reasonable. So when you build your first bridge across a river, it's very productive, saves people hours of time getting around. Your second bridge across the river is not as productive. Now what you're doing is you basically, your traffic jams on the first bridge, or you get people out of those and onto the second one. By the time you get to your fifth and sixth bridge, it's actually very hard to actually work out what's going on, but also to the incremental benefits to an economy is obviously a lot less. And so what we've seen from China is China's basically led the world in terms of the it's spending capex levels relative to the rest of its economy higher than we've ever seen, and that's what we're seeing on this chart. The other countries crashed once they hit the end of it, and couldn't maintain that level of capex because at a certain stage it's just not economic to keep building roads and bridges and airports when they're not being used. And China is trying to manage that structural change. That's the big picture, how we see the Chinese economy. And then now it's just a question about how do they manage that change, and is it a short sudden stop at the end of it, or do they manage to get sort of a smooth landing? Over a long period of time.
And you can see there that there is, a precipitous fall for pretty much all of the lines there, apart from China. Is it just a matter of time, Damien? Do you think that this will happen, or is it going to be sort of a slow burn?
Look, I suspect they're probably going to go more the Japanese path than the Thailand and Korea path. The Thailand and Korea, you can see coming to a sudden halt on that, sort of in the Asian crisis of the late 90s. Japan tended to, although there's certainly in financial markets there have seen some quite precipitous falls, but the capex to GDP sort of managed to stretch it out over a long period of time, turned it into these zombie companies and just really deflation for years and things like that, and we suspect that's probably more of the path China's going to try and take.
Okay, sure. And so obviously with Japan, as you mentioned there, vis-a-vis the rest of the world taking on substantial amounts of debt, it's probably not a bad segue into our next slide being exactly that. So do you want to talk us through this one here?
Yeah, so this is the debt levels within China. So this is the key bit over the last sort of 5 or 10 years. You note that back throughout, say from 2003 to 2008, the levels of debt in China actually fell, and this is when GDP was growing the most in China. So they managed to grow GDP dramatically and decrease the debt at the same time, decrease the debt to GDP. And the reason for that wasn't that they weren't going into debt and paying back. They were just, the debt was growing more slowly than GDP. So GDP was growing at 10%, and debt was sort of growing at less than that, which enabled them to decrease that level. Since the financial crisis, though, that hasn't been the case. So they had this big spurt following the financial crisis to help sort of rescue the economy. And then from there on, we've seen that it's pretty much been a straight line upwards as now they're sort of similar levels to what the US is in terms of the debt to GDP, with a much with their citizens earning a lot less in terms of per capita. So it's sort of it's more problematic. If most of the income that your citizens have go into housing and basic needs, they don't have as much to service the debt. Whereas if you're a more developed economy, you can, having a higher level of debt is more sustainable.
So really, it's the double whammy there from about 2011, where they've had an increase or a continued increase in GDP, and then on top of that, a massive increase in debt.
Yeah, and then the next slide really drives that home. And keeping in mind with all these slides is that the GDP we think is inflated. So the numbers here are actually they're worse if you
they're hiding debt.
They're worse if you use a lower number. Yeah,
sure.
So and especially on some of these where you go, yes, we've just spent $2 billion to build a new airport, and nobody's using it. That sort of sits on both sides. Whereas if you said, oh, well, we've written down the top half of it, it'll look a lot worse. This one is now just showing the same basic graph, but it's just showing you that how much credit has gone in, how much when you invest more debt, how much GDP growth do you get for that? And you can see that it's sort of gone from 2 or 3 times on that blue line back in the 90s and early 2000s, and now we're at 15 times. So it's just the amount of extra debt you need to fuel a 1% increase in GDP has increased astronomically.
So less bang for your buck?
Absolutely.
Okay. Talk us through the next one here.
Yeah. So the danger of everyone wants to know about is when does the whole thing come to crashing to a halt, and how much bad debt's within the system. Now, systems can handle bad debt. That's what our banking systems are designed to do, and China itself went through this in the early 90s on a much smaller scale, where they had a housing crash, and they basically bundled all the bad loans into some companies, and then into some banks, and then sort of good bank, bad bank, and let them sort of run off. This one though is showing how much potential credit losses there are within the economy. Now, what it is it's the credit to GDP gap, which is basically a complicated way of that the World Bank's using. So it's basically the Bank of International Settlements. So there's a framework for banks called Basel III, which is basically determines how much credit to GDP you can have, and they make estimates from that. And that's what this chart's showing, is that based on those estimates, China is sort of far and away above the rest of the world in terms of the amount of potential bad debt there is sitting within the books there. Now, and as I said though, that China's a little bit different, or very different to a lot of the developed countries, in that the banks are quasi state owned, and there are ways they can bundle them into entities and do the same thing as what they did in the 90s. However, the larger they let this problem get, then the more problem they're going to have trying to solve it. And
so ultimately, could we be staring down a similar sort of situation as the US, where they just print their way out of it or something like that? Just say hell to the currency.
They might do. I think we're sort of expecting. It's a fragile system, so you could have a crisis. But the main thing with this is if people maintain their confidence in the Chinese authorities to manage this, then we're fine. They'll bundle it all into some bad debts. They'll drag that out over 20 years and things like that. But you could lose confidence in the system, and so that's where it's something you can't. That's not our base case, but it's certainly a very real risk.
Okay, very good. Sure. And so now, I guess, in comparison to the United States.
Yeah. So this is moving on to some other structural problems. I've just got a couple of other minor ones. Oh, sorry, not minor ones, but other structural problems you've got. So we started with this whole capex to GDP issue. They're spending too much on capex. The next problem is it's debt funded. Another problem you've got within the Chinese economy is this rising inequality. Now, official statistics sort of show that inequality is starting to fade away. Starting to come back, but unofficial estimates tend to say that inequality keeps rising within China. So basically, you're getting a small amount of people making most of the money, and that tends to lead to civil discord, and it also means that you want the Chinese consumer needs to pick up. So that slack between capex and is basically a play between a business is spending money or a consumer spending money. And you want the Chinese consumer to pick up, and to get that, usually you need low levels of inequality. You need that money spread around to lots of people who can go spend it. Because if you give more money to the richest people, they tend just to save it, whereas the poor people tend to spend it. So yeah, so we want inequality lower.
And there's no opportunity for the Chinese to vote in a Trump.
No. There's not a lot, not a lot on the voting side there.
Sure. Okay.
Demographically, then they've got the same. Another issue is this one. Sort of the bottom chart's the more interesting one here. So this is what's called the dependency ratio. How many workers are there for every person that is that's either too old to work or too young to work? And so you can see that in the sort of 60s and 70s, you had hardly any workers within that. Most of the economy was going to either and then over that next sort of 20, 30 years, that declined. So that's been a great boon, because if you've got a fixed amount of population or a certain amount of population, and you've got more and more people working and fewer people either too young to work or too old to work, it's very good for economies and growth. That's turned in the last sort of 4 or 5 years, and it's because of the Chinese one-child policy. It's going to get considerably worse over the next 30, 40 years.
Okay.
The final one then is trade. Now this chart again is it's probably a bit more dramatic than it probably really is, because of that overstated GDP numbers. But what it's showing is that exports as a percentage of Chinese GDP is shrinking. So we've seen that over and that's been, so it's basically a negative for economic growth in terms of China. It is a good thing for one of the ways to get out of this is we want that Chinese consumer to grow and the businesses to take a step back as part of the economy. So what you do actually want is you want to hire yuan, and so that Chinese consumers can afford to buy more goods, do some more importing. China does a bit less exporting, and the whole thing rebalances a bit. But I guess the other structural issue is that I wanted to sort of mention was that trade has peaked, and you can't expect more growth in trade to rescue China from this. That was the story of the 2000s. Now we're onto something else.
So is it really just, I guess, the role of a growing middle class? Is that sort of the direction that we're hoping that China heads?
Absolutely. You get consumption growth continues, and you get less inequality there. You get the consumer picking up and spending more, and the money spread more widely, is the best case.
Okay, lovely. All right. Well, look, thanks for that, Damien. And what we'll do is we'll hand over to David. Welcome, David. We better just check the mic. There we go.
Thanks, Tim.
Fantastic. So cyclical. So obviously you've been writing about the rise and now potential fall and things to think about with China on the Macro Business blog for many years. Do you want to kick off your side of the story with the cyclical piece?
Sure. So that first chart we've got there is a history of Chinese broad credit. That's total social financing and bonds. So that covers corporations, governments, and households. As you can see, there have been 3 waves of stimulus, more or less, over the last or post-GFC period, with the enormous stimulus that we had coming out of the GFC directly. Then Xi Jinping arrived amid some fanfare for reform and what have you about Chinese debts, but immediately he stimulated again in 2013 as he kind of consolidated his power. And then again in late 2015, when we were going through, the really wrenching bust in commodity prices, China then put the foot on the accelerator again. And you can see that last mound of stimulus has now been sort of coming off for the last 6 or 12 months. So the crucial point about that is that Chinese growth, particularly CapEx, tends to follow this cycle in credit by about 6 or 12 months. So we've started to see, China's macro indicators come off with that rollover in credit in the last kind of 2 or 3 months of data.
And so you can see there, the sort of peak to trough or trough to trough, we're sort of looking at 3 years. Do you expect that to sort of continue in a downward sense, or what's the forecast?
I do. I mean, we've just come out of the big National Congress at the with Xi Jinping consolidating his power again. He is sort of broadly still considered a reformer, and with some drive to address, the structural challenge that Damien outlined about, trying to reorient growth away from credit and capex towards the consumer. So I think they're going to have another crack at it, and that's what we're seeing here is the first signs of a new round of tightening in that respect. Whether they can persist as it inevitably causes growth to fall is the next question.
Okay, very good. And you mentioned there with the consumer, obviously a big part of the Chinese investment is through their property investment, and you hear the stories of the enormous property prices in places like Shanghai and to a degree Hong Kong.
That's absolutely right. I mean, one of the key dimensions of the last round of stimulus that we just saw was household loans. We saw a lot of activity in mortgages, especially in top tier cities. And that slowly spread, more to the country and the lower level cities, what we call lower level, of course, but, in actual terms, they're far bigger than Australian cities. You can see that those mortgages have now been coming off pretty fast for the last year. That's owing to the PBOC, the Central Bank of China, tightening a lot around lending standards in the same way that APRA has been doing in Australia. That is, they haven't raised interest rates. They don't want to sort of burst this bubble, as it were. So they've been relying on what we call macro-prudential in the same way that Australia has. And at a sort of city-by-city level, they've been tightening mortgage conditions, which has meant that property prices have actually come off in a slightly less precipitous way than previous cycles. And next year, I don't actually expect property to bust in China in the same way that it did in the last cycle, kind of 2014-15. I think we're looking more at a kind of slow melt or kind of plateau. They're trying to stall that market without killing it, because it's very central to, this is where it's a bit of a conundrum, of course. It's central to investment and capex, but it's also central to confidence and consumption. So they're trying to bring that off without crashing it, a soft landing, if you like.
Okay, sure. And so then I guess the next stage in the borrowing cycle is obviously the creation of bonds and the issuance of bonds. So do you want to lead us through this one?
Yes, of course. And this is where you're really in the heart of the capex boom. And you can see that, again, they really hit the accelerator hard in late 2015. Excuse us while we just turn that off. And equally, that's coming off quite fast again now. And so, a lot of this is local government building that goes hand in hand with the housing boom. So I expect this to come off further, but again, there may be a bit of a tail on it if needed to keep, some growth up.
Okay, sure. And so then moving on to growth. Okay, so we've got there the fixed asset investment in industrial production and retail sales all look like they're plateauing. And
that's right. Well, all except fixed asset investment, which is the key one for an Australian investor, because that's the capex. That isn't plateauing. That's continuing to fall. And in truth, we're going to have to see this number probably go negative before we get any genuine rebalancing in China. I don't see it going negative next year based on the credit flows, but I do expect that slow diminishing trend line to continue. Call it a kind of falling glide slope. And we can already see that if you move to the next chart. In a similar glide slope, this is property sales by floor area. Forgive me for having the Chinese on there, but this is year to date. So it's a year to date comparison. You can see it's sliding there. Obviously, the numbers in year to date take longer to catch up, so they look more healthy than they actually are right now. If you look at year-on-year numbers, they're already negative. In fact, October property sales, which is very important given it includes Golden Week, which is a huge kind of property boom tradition. We're down 6.4% this year. So the leading indicator for new house sales is now falling in China, and so I expect that will continue next year. If we move to the next one, this is house prices. I probably should have had this one a bit earlier, but you can see the tightening that's already happened has brought the top tiers to heel. A lot of them are already falling or flat, but the lower tier cities are still going along okay at kind of 5 and 6% growth. The critical point here is probably, does the top tier, which has come up a lot faster, does that damage confidence enough in the wider cities? Because the top tier is really only, I think tiers 1 and 2 are about 25% of the overall market. So if tiers 3 and 4 can hold up, then it won't building won't come off as fast as it has in previous cycles. That's my base case, but it is a downside risk that you get that top tier bust spreading. So if we move to that next chart, this is new starts by floor area that's following sales. They're still up 5.6% year to date, but obviously another slowing trend line. But again, if you look at it year on year for October, you find that it's already falling. So that's the next chart, down 4.4% for October. So just turning from there to a couple of quick sort of direct implications for Australia. If we move to the next chart, I'm looking at steel output, which is very sensitive to what transpires in Chinese property. Chinese property is in one form or another, whether infrastructure or housing, is probably about 2/3 of Chinese steel demand. And you can see here that steel output is still extremely high relative to previous years. In fact, it's at records, has been all year. But if we just move to the next chart, I've included cement as well, and it actually shows you that it's actually well down on previous years. And the difference between those two is Chinese reform. So a lot of the steel demand that we're seeing in China right now is not underlying demand. What it is they shut down a bunch of illegal steel mills that weren't recorded in Chinese steel official steel statistics, and by doing so, moved that output into official statistics in more legitimate mills. And so a lot of what we see in the boom of Chinese steel is actually just a statistical figment. That said, there still is growth year on year in Chinese steel, and the difference with cement is exports on that front. But the last chart is the key one, basically. If we move on, you can see that Chinese inventory cycles for bulk commodities track the Chinese housing cycle quite nicely, quite closely. And when the inventory cycle for iron ore especially, but also coke and coal, it really is immensely influential on the price deck for the whole ferrous complex. So when Chinese house prices are rising, so is construction, then the steel mills and all of their mad speculators, they all tend to pile in and buy iron ore and coke and coal, and they just buy it and leave it sitting at ports, just as a punt, basically. And so you get these huge accumulations, as you can see there, in iron ore stocks, almost 140 million tonnes of the stuff at the moment sitting at Chinese ports, which is way above where it's ever been before. And then eventually the Chinese property cycle, as it comes off and underlying demand shifts and falls, triggers destocking from these speculators, and all of that held product hits the market. And so you see massive overcorrections in the price. I think that's what's going to happen next year to iron ore and coke and coal.
Yeah, okay. Well, thanks, David. So obviously with the end of that, the final sort of stages in that chart there, it's it's pretty ominous for iron ore prices, given the earlier falls. So certainly something that would be playing into the minds of anybody looking to invest anything to do in Australia or in Australian iron ore, or obviously in China. Which brings us on to, of course, our next segment in today's webinar. So who'd like to take the reins on this one? We're going to cover off on a couple of key themes here. Damien has indicated.
Yeah, I'll grab the first bit. So we've spoken through first of all the structural issues with the Chinese economy. Then we've spoken about the cyclical, so the longer term stuff. Now we've got the cyclical. Where's it going to at the moment? And it does seem to be on a downtrend on both those factors. So what do you do about from an investment perspective? So there's sort of two main parts I wanted to speak about here. Is that the choices China has is one is they can keep going with capex driven growth until there's a crisis. So there is still room to add more debt to it. There's certainly lots of vested interests who've made lots of money from the boom so far, and they don't want life to stop going the way it's been going, or they can go with this transition to consumer driven growth. Now our take is they're sort of sitting somewhere in between these, where they're trying to get this transition, but every now and again, when things slow down too quickly, and they do have the possibility of social unrest, and they want to keep they want to keep employment quite high, so they hit the debt accelerator, and they go back to that capex driven growth because that's what they know works. But there's there's obviously a limit to how much you can do that. So that's their options. We think they're trying to get to the bottom one, but they keep returning to that top one because it's easy and it's what they know. So then once you get to that, the next choice they've got to make is that is do you turn around and take these sort of short, sharp losses like you saw, I guess, during the financial crisis in places, and you write down your assets and then you move on. You possibly have a recession for a year or two, but then you sort of reset your economy and off you go again. And it's probably similar to what we saw in the Asian crisis. Or do you go with the Japanese down the Japanese route, which is you bundle everything into the zombie banks and companies, and then you drag the process out for sort of 20 plus years, and problems with deflation and all these other issues. But the benefit of this is it's a little bit easier. It's certainly it's over a 5-year period, it's worse. Over a 5-month period, it's generally always better. We'll put it off till later. And you just keep going with that sort of process, and that's the path we think they're trying to take.
Okay, and I guess from as a portfolio manager yourself, should we take a moment now to sort of have to think about what we're doing in our portfolios, and for those listening in?
Yeah. So from the strategy side, actually, I'll let David sort of deal with the strategy side and sort of discuss the next one, and then I'll jump in with what we're doing sort of individual stocks and stuff like that. At the end.
Yeah, sure. So final notes there, David?
So we're not seeing China as a crisis next year, not a rerun at this stage of the heavy losses or heavy bloated growth that we saw in 2015. More of a slow choking.
Sounds pleasant.
Yeah, well, I mean, that's what happens when you clog everything up with debt. Nonetheless, a material slowing in growth, especially in the investment components that are commodity intensive. For the short term, this is going to be a bit hard to read because we've got these winter shutdowns for addressing pollution in Beijing, which is distorting commodity markets and growth. And so everything right up to the end of Q1 next year is going to be difficult to read. Markets may attribute things wrongly. But once we get out into Q2 and mid-year, I expect that macro slowdown to be obvious and to be really playing out in commodity prices. So, we're not interested in miners. Therefore, when we look at where China stands with, in its global setting, we're quite bullish still on the US cycle. It's late cycle certainly, but it's got a lot of tailwinds coming out of it that are helping growth. It's tightened labour market, the oil recovery, booming consumer confidence, etc., and it's about to have a bit of rocket fuel poured over it by likely tax cuts. And so that may also help, ease the burden a little bit for China next year. So again, not some huge crash, but definitely material slowing. So, the way the US and China come together next year is that because everything's kind of priced to perfection, and asset prices are very high, we see things can run, for a couple more quarters, especially in the US. But the Fed, is kind of tightening into that. China is tightening into its investment boomlet. And so sometime, kind of maybe mid next year or entering, the second half, we could see those two tightenings coming together to deliver a pretty serious correction to markets.
Okay. And Damien, I guess from a more granular perspective, in regards to our portfolios, obviously David had some slides there, basically, preempting what looks to be a pretty precipitous fall in the iron ore price due to the slowdown in the building. Obviously, iron ore being about 50% of our of our exports to China. So, what are your thoughts there in terms of where we're placing our positions, and for those listening in, anything to take away?
Yeah, sure. I mean, and keep in mind with this is based on sort of current valuations. I guess the way we look at it is, if current valuations are where they are, we'll continue to ease off over the year, and if we see signs of and when I say ease off, sorry, reduce exposure to equities and increase exposure to bonds. But if we see any sort of sudden sharp changes, we'll look to that as we'll probably sell a little bit quicker. If markets fall, we might even look to pick up a little bit, over that time period, and there'll be sort of selective things that we'll be looking at. So it's sort of more of a playbook than it's not a hard and fast rule book. It's just sort of, this is what we'd like to do, but really we do need to adapt and see what markets have, because there are certainly we're reaching inflection points, and things can drag out for longer than we expect, or happen sooner than we expect. And so so that's what we're looking at. As David sort of alluded to, that Australia is, amongst developed countries, is the most dependent of all developed countries on China. So, of a country to avoid, that sort of makes the most sense in terms of avoiding Australia. We've also got some other issues within Australia, but we'll leave those to another day. Within stocks, as we look around sort of other stocks around the world, we tend to be still, the US is very expensive still. We're looking for exposure to the US, but we tend to be looking for it in other countries. And whether we can find stocks that are listed in other markets with decent exposure to the US, that's what we've been looking to do, and pick up those at lower prices. Given the export, and we don't expect the Chinese currency to be particularly strong, we're sort of thinking some of these non-Chinese exporters are a bit more attractive. We're not looking at emerging markets, pretty much avoiding emerging markets at the moment, and we're really looking at that sort of mid-2018 as being our key point, and just making sure that our portfolio is positioned to protect investors sort of going into that.
Okay, so broadly speaking, from an Australian portfolio perspective, we're really just looking out for anything directly exposed and trying to keep our powder dry for everything else.
Yeah, so within our Australian portfolio, very much looking at overseas things with overseas exposures, and staying away from the miners. Within our international portfolios, looking for those exporters and trying to get exposure to the US market at the right price. That's the difficulty. And then the other part is, from an asset allocation perspective, we're very much into international assets rather than Australian assets. We're very underweight Australia, and we're picking up some bonds, gradually as the more the market rallies, the more bonds we pick up, and we probably expect that to continue for the next little while.
Okay, lovely. So what we'll do now is just move into our Q&A. I'll just quickly check with Matt how we're looking with the Q&A. Please feel free to take a moment to jot down a question if you like. We can get it answered now live. I'll just grab one from an email though. And this sort of plays a little bit into, I guess, from what I can read here, when people are thinking about investing in China. So obviously industrials, iron ore, all the big stuff, major exports. But of course, what about things that probably is not so much on our radar perhaps, but maybe it is the things like when people think of, when we spoke before about growing middle class, so things like milk powder and these sort of things, market darlings like Blackmores, what have we got, A2, Bellamy's. So where do they sort of sit on our radar?
Yeah, look, these are difficult ones for me. You don't want to be. It's hard to be investing in companies that are exposed to a single country, and especially when that country has got it's very, I guess, a lot of government rules and regulations that can sort of switch the taps off pretty quickly. So so it's an area where, yes, interest in buying, but you need to make sure that you've got diversification. It's not just solely reliant on China, and that you've shown you can sell your product elsewhere as well. So we're certainly, look, we're interested in those because it sort of fits our mold. But we prefer to find companies that are actually exporting anywhere in the world. And so whether it be something like a Treasury Wines or something like that, although it is quite expensive, but something that's actually got products it's shipping out all around the world rather than going, and growth in China will help, but
it's got to be more diversified.
Okay. In terms of international portfolios, so looking offshore, ex-Australia, some of those ones, what you tend to find, especially in emerging markets, is although emerging markets themselves are relatively cheap, a lot of that's driven by Chinese state-owned entities and things like that, and companies like that, and some of the Russian energy stocks that are quite cheap. If you look within the stocks themselves, let's say that the emerging markets healthcare stocks, you actually find they're actually very expensive relative to the rest of the world. Sometimes you can actually pick up, or often you can actually pick up stocks listed in the US or Europe that have exposure to some of these India or China at cheaper multiples than what you can get the local ones for.
Wow. Okay. No worries. Thanks for that great answer. Couple that have just come in from the Q&A or from the live chat. So China is still trying to move hundreds of millions of people from rural sort of status to the working class. Politically, they need to continue to do this. Will this lead them to throw everything at growth? And how long could this last, given that the banks are state-owned and write-downs are not affecting or impacting GDP? David.
The urbanisation story is not over, certainly by a long stretch. But the key point to make about it is that it's peaked. Off the top of my head, I can't recall the exact statistics in terms of the numbers shifted from country to city.
It's about 20 million.
Over the last 5-year plan, but the next 5-year plan is less, considerably less. And so even though we're talking very big aggregate numbers, what matters to commodity demand is actually rate of change. So it doesn't matter that they're still moving, millions of people into the cities if it's 1 million less than it was the year before, because that's actually shrinking growth. So the key point to make is actually rate of change, that the peak in urbanisation is past. It passed around 2011-12. And so I certainly don't see any kind of huge crash in Chinese steel demand in the short term, but as that urbanisation slows, it means, what was sort of 800 to 850 million tonnes of steel output today, over the next decade is likely to shrink to more like 600 to 650.
Okay, thanks for that, David. And maybe just another question for you here. We've got a question from Ed. Does iron ore held as port stocks deteriorate, or can it be stored indefinitely? I guess there's a holding cost, is there, or what needs to be? All right, we'll grab Damien for this.
Yeah,
one.
Sure. I mean, look, it lasts a long time, absolutely, but there is a cost.
Does it?
You've certainly got issues with that, but there is a cost, and the main problem with iron ore is it's bulky, so it's not something you can just sort of it's not like something you can just sort of wrap up and stick in the corner. You do need considerable part to it, and the issue with speculators is the speculators who have got it, they're in for a quick buck, And if you said to them, "Oh, look, just hold on for 2 or 3 years and you'll make all your money back," they've got other things to play with. They've got Bitcoin or something else they want to go out and buy. So the idea for that, it's been bought as a Ponzi. I'll buy this so that I can sell it to somebody at a higher price. Once your price is falling and you've got these ongoing costs of storage, then we think the speculators will turn pretty quickly. As you can see from that, that graph is that every other time it turns quickly.
Okay, so ultimately, whilst there's a short-term ability to sort of buffer the demand, eventually it's just going to go straight on market as the costs burn people out.
Yeah, I mean, the volumes we're talking there are massive volumes. Like, you're talking acres and acres and acres of storage for this.
There is also an issue here in terms of iron ore grades, which I didn't really touch on. Limited for time, but I'll just do it quickly. I mean, we can't be certain about this, but it is rumoured that a lot of the port stocks are lower grades, so 58% iron ore versus the 62% that BHP, Rio and Vale tend to provide. And so, the risk in this market, it is to all miners, but it is especially acute for those who have the 58% and below stocks. And that's already knocked out a lot of Indian supply, which never returned after monsoon in the last few months. Because the gap or the spread between 58% and 62% is at unprecedented levels, and this is because mills like to use the higher grade stuff as pollution controls come in. That means that Fortescue is more at risk of severe falls than a Rio or a BHP if this destock transpires, because there'll be more of that lower grade ore coming on to market. That said, if coking coal falls as well, and it should, then that means that some of the 58% ore will become more attractive to the mills. So there'll be some offset. But I think that the spreads we're seeing in iron ore are at least in part structural. So it means that Fortescue is more at risk than some of the big miners. And we're actually seeing that in their respective share prices, with 62% iron ore rising strongly in recent weeks and Fortescue going absolutely nowhere.
But not quite yet to call a Fortescue short.
Oh, well, I don't call shorts, but well, I don't think its chart looks very good.
Fair enough. Okay, no worries. Thanks, David, and thank you, Damien, for those answers. We've just checked, so I think we're all done for the live Q&A. Feel free to you can always more than welcome to send through any questions to webinar@nucleuswealth.com as well if you need them answered after this. So on that note, we'll just quickly zoom through a little spiel on us, of course. So we, as an investment house, we use a separately managed account, which gives all our clients the ability to hold international share portfolios that we manage for them, and obviously allows unrivaled amounts of transparency. We use our platform provider Linear, who's backed for the cash management by ANZ Bank, and for the custodian of the assets through JP Morgan, one of the largest investment houses or banks in the world. We can also provide 19 ethical screens for people who would like to obviously have access to the large, well-run portfolios that we do, but would also like to potentially knock out some companies that are dealing in areas that they may not necessarily agree with. So we can be very granular with the way that you can set up your portfolio and obviously make changes ongoing. And just wrapping up, so obviously on top of the 19 screens, we offer a complete investment solution. We've managed to bring the fees down to certainly very, very, I think, competitive rate through removing largely a lot of the middlemen that you'll find in many sort of investment options out there. Obviously, I think we've heard enough from the investment team, the experience in the investment team today. We've got the transparency, but also the tax effectiveness of having your own individual stock portfolio and not having to deal with some of the tax issues from managed funds that sometimes can sit in the background as well. I'll just quickly make you aware of our next webinar. You're more than welcome to come along. Please feel free to sign up at proton.nucleuswealth.com. It's called The Future of Energy, and it will be on Tuesday the 5th at 12:30, same bat time, same bat channel. And just finally, as we always do, to anyone who's registered for attending, we send out just a quick survey. It takes about a minute. I think there's about 6 questions to do. But what it does is gives us a little bit of feedback on obviously what you've heard today, and also a bit of direction on where you'd like to hear some more information about. So, on that note, thank you very much, guys, for coming in and helping us out with some real investable information on the rise and fall of potential fall of the Chinese economy. Thank you from myself, Tim Fuller, and we'll look forward to catching you at the next one. Cheers.
Thanks, Tim.